So welcome to our webinar on the Horizon 2020 SME Instrument. This is a relatively new program that was put in place by the European Commission in 2014. And now we have 4 years of experience with companies applying, some failing, some succeeding. So the idea today is to present you some of the characteristics of the instrument to help you understand what companies in your portfolio could benefit from that instrument. And most importantly, to find out what are the drivers for success given the extremely high competitive level of this instrument. So first of all, a little bit about what we are looking for as Zaz Ventures, but also, of course, what the European Commission is looking for. The SME instrument is about market creating innovation. And that's really important to understand because not every company has this focus. If I take the example of artificial intelligence, that's a really interesting technology trend. Many companies are developing components, sometimes claiming they are developing AI, not always the case, but there are some very good AI companies out there in Europe raising funds. Now, a few weeks ago, we got an AI company calling us for support, asking to write a project about how to use AI to support the customer relationship management solutions. So essentially, AI to improve the capacity of the sales teams using CRM tools. And while this is a perfectly fine objective, and probably the company will be quite successful in its market and also raising private funds, it's not the ideal innovation for the SME instrument because it is not a market creating innovation. It is more of an efficiency creating innovation. In short, this type of technology should simply improve the capabilities of sales team, which means probably reducing some of them, which means killing jobs. And that's not necessarily what the Commission has in mind with this instrument. On the other end, around the same week, we had another AI company contacting us, which had a different view. They would use AI to power a chatbot, which can be used to provide support to individual people who are starting to suffer from mental health problems. So, for example, you think you're falling in depression or you have anxiety problem, but you're too ashamed to go and talk to a human. You're too ashamed to go and consult with a psychiatrist. So you can interact with that chatbot, which is very well structured and has been built by professionals. So it enables you to make the first step. Now, this is very interesting from a perspective from the SME instrument because we are creating a new market. We are allowing people who would probably not have gone to psychiatrists, or maybe they would have, but probably too late when it's quite difficult to recover. And we give them an option to interact with something because it's not a person, which might even make the relationship easier. So this is a really good example of how AI, which is a exponential or disruptive technology, can apply to both efficiency creating innovation and market creating innovation. From the purpose of the SME instrument, we are really looking at market creating innovation because they will generate not only revenues, but also job growth. Now, what we do in that context is to write or to help write the applications that will then go into the competition to decide if they will receive funding from the European Commission or not. It's a very difficult competition. The average success rates are between 4 and 8%, depending on the stage you're in. But when it comes to the most interesting stage, it's actually called phase 2, where we can raise up to 2.5 million euro of non-dilutive funding. That percentage is closer to 4% and probably even lower going into next year. So to be able to develop a proposal, you need to be really sure that it can be selected in this very exclusive competition. And we do that based on success fee only. So we select companies, of course. We have to be very selective in the case we will take. In fact, we will apply some due diligence processes, the same as you have been doing with your own companies to decide about investing or not. And we'll do that because simply we are going to invest. We're going to invest not money directly, but we're going to invest our time in a process that has an average very low chance of success. Of course, the best company can and will succeed, but it might take time. So another important thing to keep in mind is to be patient in that type of process. We keep a focus on market creating innovation, but especially around what generally is referred to as deep tech. It's easier to get a company with deep tech funded because in general there will be more IPR, it will be more defensible, there will be more innovation. So when we see innovations which are a bit incremental, which are more like a combination of existing technologies, I'm not saying it's impossible to get them funded, but that's slightly more difficult. And of course, there are different topics. In fact, the instrument in itself is completely bottom up. So we can come up with a technology from any field, and you can also come up with a business model innovation. It doesn't have to be necessarily a technology innovation. So what we've done so far since the program started in 2014 is to produce a lot of applications, both in phase 1 and phase 2. I'll come back to what they are a bit later in the presentation. And we have now actually a round number. It's a bit of a coincidence, but we have 100 companies that got funded through that instrument. 65 in phase 1 and 35 in phase 2. We learned a lot from that. We learned because we could see which companies are successful and which aren't, but also, and more importantly, we followed this company. And after raising EU funds, they went on to continue their development. They raised some private funding, sometimes quite a lot, as you will see later. 3 of them went public. And then we can say that the funding that was allocated from the European Commission definitely acted as a springboard or an accelerator for their growth. So what is the SME instrument? You may have experience, direct experience through some of your portfolio companies, and we have heard some stories around it. Not all stories are true, so I'll try to be as factual as possible and to describe exactly how it works, but also what we learned from the applications that we've done in the past 4 years. First of all, you need to understand that the value of this instrument is that it does not behave like an equity investment or even a loan. It's pure subsidy, which is great for the founders and also for the existing investors, because the company can raise up to 2.5 million euro without incurring any dilution. Also, they do not have to reimburse that money. This is a grant. It's based on a work plan that has been defined at the application stage. And it doesn't have to be reimbursed if you are successful or unsuccessful, as long as you have done the activities that you had committed to. Which means that the whole grant currently is delivered or given to the company based on efforts and not results. Also, which is a good thing for cash-strapped companies, the Commission understands that you're not going to wait a year to get the first funding. So they're not going to ask you that. They will give you, in fact, pre-financing around 45% when the project starts, which is great because that means that you can really conduct the activities without worrying about the cash flows. Now, they will not fund 100% of the activities. They will fund exactly 70%, which means that at some point you will have to come, or the company will have to come with some co-financing. Which is why companies who already have angel investments or VC investments are kind of perfect for that, because if they are in the process of raising a follow-up round, they can simply limit the dilution by raising funds from the European Commission as a grant and then just adding a little bit on top from their existing investor. They don't need to go for a new round with a new investment lead. There are also drawbacks. The main one is because this instrument is so interesting, there's a lot of money at stake. You can apply. The process is relatively short. Many companies have been applying. It's often that we see up to 2,000 companies applying at a given deadline, but only 100 will get funded. So you can imagine that this creates really high competition, especially that you are allowed to resubmit as many times as you want. So the proposal keep improving. And in fact, because it's such a competitive scheme, it has attracted a lot of consultants. So you can expect that the best proposals are always developed by consultants in practice. The time to grant, although it has been reduced, is still substantial. So you have to be a bit careful there. You submit, then you get the results within 2 or 3 months. And after that, you need another 1 or 2 months to get the grant signed. So the minimum time to grant is really 5 months. And in practice, it can be a bit higher, especially when the EC is starting to throw some paperwork in the way of the company. So that's a drawback, and it's difficult to compress this further. They already try to improve it quite a lot. The application itself has some level of complexity because it's not a free format. You have to follow a fairly specific and constrained template. There's even like a page limit. So for example, in phase 2, it's a 30-page document. You cannot submit more than 30 pages. And of course, you have to produce as much content as possible in those 30 pages. The grant come with some kind of overhead, unfortunately. That means that once you have been awarded the grant as a company, you do not have to give any equity to the commission. You don't have to give any IPR to the commission, but you have to do one thing, which is to show the commission that you are doing the activities that you committed to. And that means reporting, because the commission is not going to go and look at the code of the software to find out if it works as it should work. They are going to base their assessment on reading reports. So there's a certain amount of reporting overhead, but first of all, that is also part of the budget, which means you're getting paid for that at 70%. And it's not rocket science. They're asking you to simply prove that the money has been used, as you were saying, it'd be used wisely. And it's simple to understand because in the end, this is taxpayers' money. So obviously, you want to make sure that the money is correctly used. There are funding installments, which means that you're not going to have a smooth cash flow every month. First, you get 45%. And then after 1 year, you might get 40%. And then after 2 years, you might get the remaining 15%. So you have to be ready for these type of cash flows. And this is simply important to plan. Now, there are a number of myths which have been going around. They're quite hard to kill, so I want to go through a few of them quickly. The first one is about the value of lobbying. Now, the SME instrument or any other types of H2020 funding is really not given in relation to lobbying. And lobbying has very little to do with the evaluation process. There is lobbying going on, but lobbying is going on at the work program level. So when the Commission starts to design the program, to agree on the evaluation criteria, to define the topics, that's when all of the countries, all of the association, all of the lobbies get involved and try to make sure that it goes their way, that the money will be available in certain areas that they're defending. Once the program is set, there is no way to influence the evaluation, simply because the evaluators are independent third-party persons like you and me, who are part of a pool of experts, and they're not employed by the Commission. They're not in contact with any lobbyist. In fact, when you apply, you don't even know who they will be, at least not in the written stage. You might know who is going to be in the jury when it comes to the pitch in Brussels, but that's a later stage. So lobbying really doesn't do anything. And any company that would claim that they can influence the result and they know it very well, and they have some people who have been evaluators before, or they have an office in Brussels, so it means they of course know it very well. That's really not the reality. That is just a marketing argument. The second myth is about the countries, and that's something easy to understand, because when you look at the raw numbers, for example, the most recent phase 1 results, it was striking to see that Spain had 48 companies funded, and the closest following was, I think, Italy with maybe 20 something, and then France with also 20 something. So it was quite surprising to see that, wow, Spain is double the amount of case from any other country, including pretty big countries like France or Germany. But that's quite easy to understand. It has nothing to do with a bias in the evaluation process. It's simply because these countries have more application, because currently in Spain, it's very difficult to get national funding for SMEs. As a result, they turn to the European instruments to be funded because that's the only thing available to them. In fact, the national government has even incentive to push them to this European scheme because they want them to suck as much as possible of that funding. So this is the result. Of course, they apply more and then they get more approved. But in terms of success rates, they're actually in the average. There are countries who succeed better, but they are not the ones that you would see on top of the rankings. The best percentage happen to be countries like Ireland, Sweden, and Netherlands currently. They have much smaller numbers of company funded, but they have a very high percentage of company funded. Maybe because the innovation ecosystem is better, maybe because their language skills are better. In any case, they are a little bit advantaged, but not as much as you would say by looking at the raw numbers. One common complaint about the EU funding is that some companies will die, run out of cash before they get the EU money. That is not the case. As I said, in general, the companies receive 45% upfront, which is quite a lot of money. So in fact, the only problem I've seen is that some companies have just forgotten that they have to raise some co-financing because they got so much money up front, and then they run in trouble at the end of the project when the commission is asking them, where's the co-financing? Because if you didn't co-finance, then you owe us some money since we are not funding 100%. But in general, cash flow is not really an issue for this once the project has started. Red tape, yes, there is some, so it's not entirely not a myth, but I would say that the process has been streamlined, at least the EC tried. And to be honest, the reporting that is being asked, also sometimes cumbersome, is really focusing on checking that the proper activities have been conducted. Funding levels are too low. I think that's not the case for Horizon 2020. We're talking about 70% funding, which is really not bad. And in fact, the Commission also allows the SME to charge an overhead rate, which is a flat rate. So even if the company would have no overhead, they would run out of a free office space and without any electricity or whatever, they would still get 25% on top of the direct cost. So in practice, it means that if you have €100 of direct cost, for example, paying some salaries, then you will actually receive not €70, but in fact €87.5. You can even claim the time for founders who are not receiving a salary, because in that case, the Commission recognized that it's a kind of sweat equity, so they should also, it should trigger some kind of funding from the Commission, even if there is no cash outflow for the company to pay the founders. The final point is about research versus innovation. It is true that previous frameworks of the program were really focusing on research, so pretty far from market, typically 4 to 5 years. This is not the case anymore. The SME instrument is really dimensioned for projects which will come commercial within 2 years. In fact, it's very often that in phase 2, companies have already started to sell some products and they have early revenues. And that's not a problem at all to get the funding. In fact, sometimes they're even advantaged because they can show some commercial traction. So what are the alternatives for a company going into these programs? It can be a bit overwhelming because there's so many instruments. Within Horizon 2020, but also outside, there are other programs, international, bilateral, national, and so on. It's not so difficult to find important ones. And if you look at the high level, essentially it depends on the technology maturity. If you're early stage, if you're still in a research or proof of concept, then you can go towards instruments like national funding or the Horizon 2020 program, which funds research and innovation. In that case, you will have to build a consortium and apply as a consortium of companies, because typically in those stages, it's about combining research, academic, SMEs, sometimes large industrials. If on the other end, you are closer to market, you have a minimum viable product prototype, and you know that this will be launched now or within 2 years, now you are more into the innovation stage, and you can go, of course, to the SME instrument. That's where a lot of money is currently. But there are also alternative programs like Eureka, Eurostars, who are good alternatives because they tend to have a higher success rate. They're a bit less interesting in terms of financials, but they are easier to access. The amounts are substantial. The Commission started with about 350 million euros when they started the program, the SME instrument in 2014. But this year, the funding is already at 460 million euros, and next year it will be 500 million euros. So it's not insignificant compared to the overall amount of financing which comes to startup or growth. So if we compare the different instruments available, we will focus really on the SME instruments, but I will show some of the differences. The SME instrument has specific characteristics. The main one is that you do not need to apply as a consortium. You can apply as one company, as long as, of course, you are an SME by European definition. And there is some criteria to fulfill there in terms of size and ownership. Which is important for you to keep in mind, by the way, because the ownership, if you are a venture capitalist, as long as you don't go above 50%, the company that you own is still an SME. If you go above 50%, then you become a linked entity, which means that your investment can still be an SME, but they'll have to calculate their SME status based on the consolidation of your numbers and their numbers. So it can still be an SME, but sometimes if you are a large venture capital firm, it could put the company out of the SME instrument scope. So this is something to check before you do any work, and that's something that we can easily tell you based on the specific situation. So SME instrument is for a single applicant. It works with two phases, a very small, short phase for market feasibility, where the company only receives 50,000 euro, and a second phase, phase 2, where they can apply to a much larger amount, typically around 2 million euro, but you can ask for up to 2.5 million euro. There are no topics, so you can come up with anything you want. The only requirement is that you should already have a prototype of the technology when you apply. So you're not just funding a business plan, you're funding an existing technology that has been tested with some early customers. There are continuous, but there are several cutoffs, so it's a continuous submission. You can choose your cutoff. There are 4 per year for each phase. And the two phases are independent. So you do not need to go through phase 1 first. You can go directly to phase 2 if you feel strong enough. But it's usually advisable to go through a phase 1 exercise to deepen your understanding of the market and make sure that you increase your chances in phase 2, which is, of course, the most competitive phase of all. If the SME instrument is too competitive, which happens sometimes, it's not for all companies, there are other instruments which have a higher success rate. For example, you can apply as a consortium. It's a little bit more cumbersome to put together, but the success rates are typically 10 to 15%. So it's also more chances. You can also apply as a mini consortium. There is a framework called Fast Track to Innovation, allowing that. And there is also a separate program called Eureka Eurostar. Here again, higher success rates, but a little bit less interesting funding. So going back to the SME instrument, how does the evaluation work? All of the proposals are scored, evaluated by external experts, third-party experts, which are working for the Commission. They're not employees of the Commission, they're working as external experts. And they have to file an individual evaluation report, which is done remotely. So you can imagine 4 experts working from their home, reading their proposal, and then reporting back on the value of each proposal. They don't spend a lot of time, typically maximum 2 hours per case, so it's a quite quick evaluation. And then the Commission will calculate a score based on the median of each evaluators. In practice, it's the median of each sub-score for each evaluators. And that final score is something between 0 and 15. But of course, there's very few proposals score below 8. Most proposals get clustered between 10 and 15. The problem is that there's not enough funding to fund all excellent proposals. So what the Commission needs to do then is to rank the proposal by score and start distributing the money from the top until it runs out. So in practice, although in theory, proposals that have scored over 13 points should get funded or could get funded. In fact, they receive something called a seal of excellence when they are in that case. These proposals cannot all be funded. Only the proposal that score 13.9 or above will get funded in practice. So that's one of the problems. The Bell distribution of the scores mean that many proposals end up between 10 and 12, which is the sort of good category, or even 10 and 13. And that's not sufficient to get funded. Even if you are above 13, that's still not sufficient. The actual funding comes 14 and above in most cases. And that's something important to understand, because in general, that creates a lot of frustration for the applicants. They get a evaluation report like the one I showed earlier, which doesn't say much other than the score. And then they feel that, well, they're so close, because they just scored 13.2. Well, the problem is with 13.2, you're probably in the top third of the proposal, in the top 30% or 35%. That's not good enough. You need to be in the top 5%. And that's a big problem, because to improve an application from good to excellent takes as much time as to write it from scratch. So this is something really for the companies to understand. There are people who get stuck. They just keep reapplying over and over again. They are stuck between 12 and 13, and they will never make it. They would have to overhaul significantly the proposal to be worth of 14 points or above. So there are several deadlines, which is why people keep resubmitting. There are 4 per year. You can see here the next one coming up. They are typically well spread for phase 1, but when it comes to phase 2, unfortunately, there's only one after summer, which means that the next one, October, is going to be extremely competitive. And then it will maybe quiet down a bit in January and then reaccelerate afterwards. But as you can see, there is a smaller gap between the 3 deadlines, which are earlier in the year. The Commission has introduced a new step, which is a face-to-face interview. That was actually a big shift because they had the issue that they were feeling that some proposals were embellished by consultants. Essentially, some consultants would take a case which is not very good quality, they would get some upfront money, and they would try to make it look as good as possible. And of course, that's not the meaning of that instrument. What we write in the application has to be the exact reality, otherwise the project will fail, and it's not worth for the EC to invest. And especially that was a problem because they would never get to meet the CEO. So sometimes there was a huge difference between the application that was perfectly written by a consultant and the CEO who was even unable to explain his own strategy. So they changed that to a system where the top application, around 8%, get invited to Brussels, where the management team of the company, without any consultant, in fact, consultants are prohibited, will pitch the exact same project that they've been describing in the application. I think it's a really good step, and it really forces the best company to go through that whole process. And clearly, the people who go out of that, they will be able to execute. But it does create a little bit of a dilemma in terms of the positioning of the product and the project, because typically the SME instrument was meant originally for companies who were not yet on the market. So it would be completely okay to go with a company with beta users, a prototype, and plans to launch within 2 years. And that's okay for the written evaluation. That will still get you to the interview. But at the interview, you'll meet a very different categories of people. You will meet people like you. The jury is made of business angels and investors, and they don't have the same filters. They are much more interested to understand about the commercial traction. In fact, they think that early revenues is excellent, that the company should show that they already have some revenues. So you can see here that this creates an additional constraint on the company. They need to be almost on the market, but not yet, but still a little bit. The kind of a strange situation. As a result, the company that perform extremely well, in fact, are the companies who have an existing revenue stream from an older line of product and are about to launch a new one, because then they can show that, well, that's a new product, it's not on the market yet, so they fulfill the requirements, but they have the commercial traction, they have the sales network, so they will be able to execute in a new plan. What I'm saying is just an observation from the pitch that we've seen. We had about 18 companies pitching in Brussels. But of course, there are industries where sales don't really matter because it will take a long time to get to the market. And that's typically true for healthcare. In healthcare, of course, the jury will never expect you to have revenues because you still first have to certify the device with the FDA and others. So that's not a problem. But if you have a software company, then they would really expect to see some numbers. It could be users, because sometimes with a freemium model, you will build a free user base first. It doesn't have to be pure revenues, but they want to see commercial traction. So it's difficult to come in phase 2 and say, well, we just launched, we have a couple of users, and if you give us the money, we'll be very successful. Probably will not fly very well. Once the company reaches the interview stage, they have around 50% chance to get funded. So half of the companies going through the interview will receive the money. The other half will be rejected. And that puts them into a bit of a strange situation because, of course, they're allowed to reapply and they might get selected again. But in general, because the pool of jury members for the phase in Brussels is quite small, it's very likely that there will be a person that has already seen the company in the previous stage, at the previous cutoff. And then it creates this strange first question saying, okay, guys, we saw you 3 months ago, we told you no, what did change so much? So there is a certain issue of timing here. You want to make sure that when you hit phase 2, you're not burning yourself with a disastrous first interview, which create a very bad opinion of the reviewers. And even if you get new reviewers, they will know that you already went to the jury, they said no, etc., etc. So what is that we are looking for this program? As I mentioned earlier, the requirement is that the company has a prototype. which has been alpha tested. So it doesn't have to be fully available on the market, but they should be real users, not just the family and friends. The company, of course, needs to have done his homework in terms of IPR and freedom to operate. So in other words, you can't really just say, well, we know that we can apply for a patent and we will think about it later. You have to already have talked about those things. The jury also expects you to have a really good understanding of the market and in particular the willingness to pay. They want proof that people are ready to pay whatever price you've set for the service. And that means that they want to understand the market, the user segments, but also what is the competition and how can you beat them. The typical project will last 2 years with a budget of about between 2.5 and 3.5 million euros. Again, here, the funding from the Commission is 70%. So that means for a 3.5 million project, you would get around 2.5 from the Commission and the rest from co-financing. Team is very important. That's one of the things that the interviewers are really looking for, the execution capability. And finally, the Commission, of course, wants to invest in technologies that will solve specific challenges. And there's a list of them, of course, that goes from sustainable transport, clean energy, health, secure societies, etc. So it's always better to be aligned with that instead of just being the next digital marketing agency, which is not specifically a societal challenge per se. The phases are meant to grow the company, to help the company grow, to accelerate the company. So it starts with this optional market study, which only brings 50,000 euro of funding. It goes into this phase 2, which is the most difficult part of the program, where you can receive up to 2.5 million euro. And once you're out of that program, the Commission still keeps touch with the companies. In fact, they have a so-called business acceleration program where they don't provide direct EU funding, but they are organizing a lot of networking events for the companies, networking with investors to raise follow-on rounds. There is an academy for entrepreneurs, networking also with corporates, with customers, and even trade shows where they are taking the cost of the booth and they're inviting the best companies of the portfolio to shine on these events. So the Commission is really trying to take a long-term perspective to follow the company through the different stages. I want to pick a few examples to give you a feeling for how it works in practice. So Mantex was one of the first companies we worked on in 2014, and they have a very interesting X-ray dual energy technology for analyzing the feedstock for biomass, for energy production, for example. We did a phase 2 submission for them, but that was interesting because at this point they were actually running out of cash. They had just launched a new product line and they were struggling to get the first initial traction in sales. But at the same time, they were eyeing possible introduction to the stock market, to the Nasdaq in Sweden. The problem was, could they make it, because they were really going through a cash flow hole. So what happened there is that, in fact, the SME instrument was instrumental to keep them afloat for these 2 difficult years until the sales picked up and they could list on the stock market. So that was kind of a perfect bridge for funding, which maybe could have been difficult to get from private investors. So that's one good example of a company building value with this investment. Sol Voltaics is also a Swedish case, different one because they had already some technology, not yet on the market, but there's a lot of investment in building these nano technologies for solar photovoltaic panels. And what we did is we also wrote a phase 2 application for them, which was successful. They got about 2 million euro, and then after that, they could achieve certain technical milestones, which allowed them to raise a lot more money at a higher valuation. So in fact, they raised another, I think, $40 million in just 2 years. So here's an example as using the non-dilutive funding to build up the value of the company to be able to raise much higher amounts without being so much diluted. Skeleton is a known example, one of the flagship of the European Commission currently. We wrote their phase 2 application. After that, they went on to raise Series B and C, but they also even went to the EIB and got a large loan of 15 million euros to build the first supercapacitor factory in Europe, which is now one of the largest in Germany. So here, a really good example of SME Instrument at an early stage that then triggered a lot of interest from the European Commission, which turned into EIB financing. We also get companies from outside of Europe. You probably know that there are associated countries, namely Norway, Israel, Switzerland, which are allowed to file a proposal in that program. It's the same also for Ukraine, actually. And in this case, this Israeli company, as many Israeli companies, had some very interesting medical technology, which they were planning to launch in Israel, US, and Europe. But at the time, because of the size of the market, they were probably focusing primarily in the US. Once they got the funding, which took a while, this is one of the examples where we had to submit 6 times before getting funded, they realized that now they have money, and of course they want to use that money in Europe, so they are going to reprioritize the European market. They organized their multi-center trial in Europe, and that created a new commercial strategy for them, which led them later on to raise also additional funding. So here, interesting to see how the funding strategy influenced their operations and made sure that they were successful in Europe. Finally, Sea Bubbles. They are a high-profile example, not funded at phase 2 yet. We got their phase 1 first, and now we are actually in the process of the phase 2. This is a very capital-intensive company. They need 100 million euro to develop this next generation flying taxis, except that those ones are flying over the water. They actually are what you call an hydrofoil craft. It's an amazing technology. No wave, no sound, full electric. That could solve really a lot of urban transport issues all over Europe. And they've gotten massive traction in terms of private funding, but now they also want to get some visibility in the European ecosystem. So that's why they are going to this program. Hopefully they will become a unicorn, and well, we hope DC will be part of the story. So another good example of a very ambitious project requiring a lot of capital, and even the 2.5 million euro from the Commission, that's still quite important for them to get for visibility, even if they will raise a lot more than that. So knowing that, when you look at your portfolio, you should make sure that they don't engage into a very long-winded effort to get this funding, because that can be very frustrating, in particular if they're trying to do it themselves. I'm not saying here that it's impossible to get it funded by yourself. I mean, when I started my own company in Sweden 20 years ago, I was writing my own applications and I was quite successful. So it is possible, but it just requires a very large amount of time, which most managers do not have because they're busy fundraising privately, they're busy selling to customers, they're busy hiring people. So you need to have someone dedicated, which is probably not the management team. It could be like an intern or some guy specialized in this, but it's kind of difficult to find someone with the right skill set that can work sufficiently to get this funded, because it can take sometimes a long time. There is expert advice available, so-called national contact points in each country, helping you with giving you some tips. Also the Europe Enterprise Network, but these people are not writing proposals. They're simply giving tips. So in practice, as I was saying earlier, the best proposals are written by consultants. That's just a fact. And so regardless of if you decide to do it yourself or with help, then your competition will be consultants, not other companies trying to do it on their own. If you decide to go for external help, a couple of tips. Obviously, it's better to work with people who work on earned success fees, because you know that they really take your case because they truly believe in it. And they also have they're completely at risk, so they are completely aligned in terms of incentive. It's difficult to evaluate the track record of a company because it's very simple to embellish it. Now, you can ask the success rates, and I'll actually mention it at the end of the discussion, but most people will just give you a random number which has nothing to do with the reality. The best way to see really who is really good at this is to ask them for how many proposals they have gotten funded in phase 2, because that's the most difficult. And by funded, I mean funded, not just seal of excellence, which means it's really great, but not funded. So if you know the number of phase 2 applications funded, that gives you a sense for are they a big player or not. If you know that they have less than 10 phase 2, well, they're just in the middle or even not there. If they have more than 25, then you're starting to talk about probably maybe 10, 15 consultancy around Europe that reach these numbers. The second interesting thing, which can give you a proxy for their success rate, is actually to do a quick ratio between the number of phase 2 applications that they got funded compared to the size of their team. Because obviously, if I'm this big Spanish consultancy, which I will not name here, and I have 100 consultants working on the SME instrument, that's just the reality. They have 100 people. Then, well, in the end, you can generate 60 successful phase 2, that looks pretty impressive. But when you look at this 60 compared to the 100 consultants, that's 0.6 index, not so impressive. On the other end, Zaz Ventures, for example, we have this 35 successful phase 2, but we only have 8 consultants. So you can imagine the success rates has to be much higher. So if that Spanish consultancy tells us they have a higher success rate than us, they're probably not telling you the reality. So never believe the sort of unverifiable claim, like I had 100% success rate. Well, yeah, but I only wrote one. Just do your research, and there are lots of good companies, but in the end, the real test is, would you take this case on a success fee only? And of course, most people will say, no, I cannot, because you understand, we have the salaries to pay, and by the way, you need to be committed, it's very important, and we're going to help you with your strategy, blah, blah, blah. For me, it's just blah, blah. The only value a consultant will bring when it comes to writing application is giving you the funding. So the rest is literature. And that's why I think in the end, if you can find people who work on success fees, do that. If you cannot, then pick the consultants that are willing to take most of the risk on success. Working with proposal writers does not mean that the company has to just sit back and relax. That's often a problem with companies thinking, okay, now we hired the top guys in the field, so they'll just make some magic with our business plan and turn it into a successful application. It doesn't work like this. Yes, it's true that the best consultants will write entirely the application, so they will not ask you to write it and then just make it look better. They actually will. We write our own application from scratch. 80% of the text in the application comes from us, not from the companies. But it still requires the raw material, which means that the companies have to put some resources. It's not a lot of time, but it does require between 25 and 40 hours that they will have to invest over a period of 2 or 3 months. So it's not zero, but of course, it's not 400 hours. Like sometimes I see some companies investing in the application, which is just crazy when you think about the success rates. So this approach means that the company will provide some raw material. We will turn that into a successful application. We'll take all the pain of writing and rewriting and improving and submitting, and if we fail, resubmitting, and so on and so on. We will also support the company during the pitch, which is quite important because actually there is a way to win the pitch. It may look like a normal investment pitch, but these evaluators are looking for specific things because the commission is asking them to look from a specific angle. So it's important to have some feedback and some understanding about what the companies are looking for and what the evaluators are looking for. So I think I've reached the end of my presentation here. I hope this was useful. I don't know if any of you has specific questions. As I said, we will be sharing the recording. So I want to thank you already.